Do you think emerging markets are suitable for all investors, big or large?
I do. I think it's different types of growth. If you're heavily invested in US or global equity, there's a large bias in your portfolio today.
How will Trump's trade policies affect your universe?
They've had limited impact on us so far. I mean, the domestic businesses that we own continue to invest, continue to execute on long-term.
Are there any golden rules which is sort of imprinted on your brain, which you still adhere to today?
Not compromising on governance.
What are the three biggest country exposures in the portfolio at the moment?
Currently, we would have India as the largest country exposure, followed by Taiwan and then Mexico.
In today's episode, my guest is Glen Finegan from Skerryvore Asset Management. And Glen has a vast amount of experience in managing money in global emerging markets. But what are your risk controls in terms of stock, sector and country level?
So we have some rules, no more than 50% in a single country and no more than 50% in a single sector.
How do you define risk? What is risk to you?
For us, risk is losing money, permanent loss of capital.
How many stocks in your portfolio do you think today have got the potential to double over the next 3 years? Welcome to Algy's Investment Podcast. And in today's episode, my guest is Glen Finegan from Scarivore Asset Management. And Glen has a vast amount of experience in managing money in global emerging markets. I think probably it's going to be the next hot subject for investors to be looking at. And I'm going to ask him a whole range of questions about why investing in emerging markets, and also, most importantly, how he and his team run their global emerging market strategies and portfolios at Skerryvore. So, Glen, welcome and thank you so much for joining me today.
Thank you, Algy. Very nice to be here.
So, I've got to ask the first obvious question. What on earth is an emerging market?
As an asset class today, it represents 80% of the population of the world.
Wow.
A very diverse set of countries. There's almost 50 plus countries across emerging and frontier market benchmarks. And that creates an interesting universe of stocks that one can build very diversified portfolios that are hopefully benefiting, of companies that are hopefully benefiting from the spending power, increasing consumption of 80% of the world's population.
Well, I think actually in answering that question, you've almost answered my next question, because my next question is, what are the main characteristics of emerging markets?
It's, again, a very diverse range. It's very hard to sort of link the shining skyscrapers of Shenzhen with much more emerging parts of the globe. But there are large growing middle classes with increasing consumption of products and services that you and I take for granted in the developed world. And many of these are still at quite early stages in emerging markets. So it is possible to find good long-term compounding types of businesses that can hopefully deliver a kind of different form of growth to what investors have been exposed to in the developed world recently, which is sort of quite tech-focused.
Well, that would be very much welcomed by the likes of Warren Buffett. Strong, long-term compounding businesses. That is something really to aim for in our chat today. Do you think that emerging markets are higher risk than developed markets today? And if they are, why are they?
I don't think they necessarily have to be. I think through stock picking, you can manage many of the emerging market risks. I think the main perceived risk in emerging market investing is weak rule of law. And we fully accept that. And I think as an emerging market investor, you have to have your eyes wide open, and your stock picking should fully reflect the fact that you may not have appropriate protections in the event of some sort of governance failure. And when identifying companies to invest in, you really must spend a lot of time understanding the history of the people behind the businesses and understanding whether or not they've demonstrated high levels of integrity over long periods of time, that they've treated all stakeholders in their businesses fairly. And that is really the best way to lower the risk of investing in emerging markets. I think you'll probably ask about currencies later. But
I will do, definitely.
Yeah, well, we can come on to how do you protect yourself from inflation later. But first and foremost, governance, high levels of alignment between us as minority shareholders and ultimately the people in control of capital allocation in companies is absolutely crucial.
And so are emerging market equities, are their returns highly correlated to the developed market equity markets like the US and Europe?
They haven't been. So obviously US and particularly US tech has had a very good 10, 15 years. The opposite has been the case for emerging markets. It's been a poor place to invest. Part of that, I think, is the governance challenge. If you look at some of the headwinds that have hit the emerging markets asset class, the wiping out of the Russian stock exchange, clearly a pretty significant failure of governance there. The kind of realization, I suppose, that a lot of very large state-owned enterprise simply don't exist to benefit their minority shareholders. Big scandal in Brazil around the Petrobras state-owned oil company, hundreds of billions of dollars of political bribery and corruption, and many of the state-owned enterprise in China also delivering poor returns. So many of the headwinds for the asset class at the top level have been governance related, but there are plenty of bright spots. Mid-cap India, private businesses have performed very well. Some private Chinese companies have performed very well. So if one is very selective.
So there's lots to go for if you're selective.
Very much so.
And then in terms of valuation between global emerging markets and the developed markets, are equities in emerging markets generally cheaper or more expensive than the developed markets?
Our portfolio is probably a better way. We don't look at the benchmark. So our portfolio is cheaper than the S&P, has better earnings growth than the S&P, stronger balance sheets than many of the businesses in the S&P as well. So I do think after a long period of in the wilderness, if you like, EM does offer a decent valuation opportunity.
And of course, in the 1990s, I remember when I used to be involved in managing money, we made some incredible returns out of emerging markets. And then we had the Mexican crisis, and then we had the Asian crisis. But even after that, they recovered pretty quickly. Do you think that the state of the finances of the countries where you're investing is as strong as it's ever been before?
Without a doubt, the whole world is starting to resemble, or many parts of the developed world are starting to resemble what feels like the definition of an emerging market, sort of erratic policy making, fiscal issues, tariff and trade wars, things like this. And actually, so in many ways, that the argument that EM should trade at some sort of a discount feels like it's going away. So I do think that the opportunity to make good absolute returns from emerging markets from here look reasonably good. And you must remember, it's after a long period of doing quite poorly. But you're right, there have been some very good periods in EM, the 90s, the early 2000s. They came out of the financial crisis in 2008 very, very strongly as well. So there's been 10-year periods where EM has delivered great returns for investors, just not the last 10 years.
Just not the last 10 years. So this is really why we're talking. How do currency movements affect the returns for investors in emerging markets?
So I think weakening currency is a fact of life. It's a headwind that you sail into as an emerging markets investor. And again, like governance, it's better to embrace and accept that this is a risk and look to only invest in businesses that have demonstrated strong pricing power over a long period of time. Because inflation isn't necessarily, weak currencies leading to inflation isn't necessarily a problem so long as the business you're invested in can increase its prices in line or ahead of inflation. So we look to own businesses that have demonstrable track records of strong pricing power. And that leads us into some sectoral biases. We own strong brand owning consumer companies like Coca-Cola bottling operations in emerging markets. We own very efficiently run retail operations that have a very strong very strong ability to pass inflation through their top line. We also lean quite heavily into sort of intellectual property-based businesses where you can point to a long track record of investing in R&D that gives you confidence that the businesses will be able to price in line or ahead of inflation. Other sectors we have biases against. We don't trust emerging market politicians, and we try to stay away from businesses that are overly reliant on them or in any way. So we find it very difficult to buy regulated utility companies because ultimately it's a ministerial decision as to what price they can charge for their goods. And we also avoid very politically exposed groups we think are benefiting from political relationships.
That is very reassuring to know. And what about the performance of emerging markets recently? There's been a big uptick in the absolute performance of emerging markets. What's caused that?
Yeah, so the last couple of years, emerging markets have, at the headline level, have done, or a year and a half anyway, they've done a little bit better. I think part of it is one of the big headwinds over the last 5 years was the bursting of a bubble in the China equity market. The China equity market represented over 40% of the EM benchmark at its peak.
That's
and
huge.
It's enormous. And it was because the underlying stocks had become extraordinarily expensive. We were constantly seeing P's of over 100 on stocks, that these prices that really didn't make sense. So what you've seen is a sort of 3-4 year period of the Chinese equity market gradually derating, companies slowly growing into their multiples. And I think you could argue that market, we went into the China peak with almost zero exposure to China. Our weightings in China are closer to 10% now. So we have taken advantage of the deflating bubble there. So that bubble deflating, I think, created a bit of a floor perhaps under EM as an asset class.
Yes,
and
so
things have done a little bit better since then.
I think looking at your portfolio, you're at times quite contrarian, which is great to see, because I read an article last night, and that this investor had done a lot of research into negative or positive commentary about China. And last year, 595 of the 600 comments he'd seen written about China from investors was negative. And surely that is the canary in the coal mine for potentially increasing exposure to China.
Yes, but very selectively. So you have to bear in mind the Chinese political system is what it is, and therefore there is a lot of political influence over a lot of that economy. So you won't see us investing in Chinese state-controlled banks or, in fact, state-controlled enterprise anywhere in China or anywhere else, for that matter. We're looking for strong founder-led franchises or founder or owner-manager type situations where you can point to very high levels of alignment. And we've been able to add China's leading pharmacy chain to the portfolio over the last couple of years. We've been able to add a leading manufacturer of medical devices, a kitchen equipment company. But these are all businesses where the founders remain heavily involved and heavily invested in the same shares that we can own. So the rules around alignment, are even more important to get right in China.
I'm finding this absolutely fascinating. So, do you think emerging markets are suitable for all investors, big or large?
I do. I think it's different types of growth. I think if you're heavily invested in US or global equity, there's a large bias in your portfolio today, driven by the fact that AI infrastructure exposed businesses have become so flavor of the month, and there's potentially a bubble formed there. And I think having some more diversification in your global asset allocation makes sense. And we can own the leading soft drink bottling businesses in West Africa. We can own leading convenience store operators in Latin America. And these are businesses that should be able to grow irrespective of whether or not there's a bust in expectations around very large AI investment. So it is a nice diversifier, I would say, for any type of investor.
And
with a sensible time horizon.
with a sensible time horizon. And I'm going to touch on that, actually, because you said sensible time horizon. For you, with all your wealth of experience, what is a sensible time horizon?
So when we're valuing companies, we look for a 10 to 12% return for over what we assume will be a 5 to 7 year holding period. So that ultimately, I think, investing in an EM fund such as ours or a strategy such as ours, one should really have that 5 to 7 year time horizon in mind.
Okay, that's very important for people to understand. Where are the political risks in emerging markets the lowest? Not the highest, but the lowest.
So I mean, political risks seem to be kind of rising globally. You know, with the tariff and trade wars and what have you being initiated in the US and inevitable sort of countering of that elsewhere. Geopolitical risks, exist. Our new forms of geopolitical risk exist for companies that have been very used to very open multinational trading. We look to protect ourselves a bit from that by leaning more into domestic consumption-focused businesses. So, for example, in April, when the tariffs were originally announced on Liberation Day, our funds went up when markets went down very substantially. So there is a degree of protection from rising geopolitical risks that comes from owning very strong domestic franchises in markets that are somewhat uncorrelated with the US. In terms of where political risks are high or low, there are some countries where we have never invested, and there are some countries where we have taken a pragmatic decision to disinvest. So we've never invested in Russia. We couldn't find companies in Russia that were run by people who we felt would put our interests on the same level as their own. We have disinvested from our only holding in Egypt. The military government there has exhibited a tendency to start interfering in the boards, and they removed the chairman of a bank that we quite like in Egypt and what have you. So when we start to see increasing political interference in businesses, it can make us quite nervous about countries. We don't currently have any investment in Turkey. It's very hard. We want businesses with pricing power that can beat inflation, but when currencies are devaluing at the rate of the Turkish lira, it's hard to find anyone who can really keep up with it.
And if I could sort of put you on point and ask you, what is your strategy's exposure to domestic consumption across your range of companies as a sort of moistened finger in the wind?
We would have about 45% of the strategy invested in what are known as consumer businesses. That's your soft drink bottlers,
that's very high.
your retailers. It includes pharmacy chains. I always feel they should be included as healthcare, but they get called consumer companies. So it's about 10 or 12% of the 45 would be pharmacy, which is more linked to healthcare spending. We also own a number of leading private banks in emerging markets. We own the leading mortgage bank in India, where only around 6% of Indians have mortgages, and there's plenty of runway for that to compound in the long run. We own a leading private bank in Indonesia, where credit penetration remains very low. Private credit penetration remains very low. So direct and indirect exposure across the portfolio is pretty high. It could be up towards 60%.
And so how will Trump's trade policies affect your universe?
They've had limited impact on us so far. I mean, the domestic businesses that we own continue to invest, continue to execute on long-term growth plans that they have. We do invest in some businesses, particularly in China, which have become successful multinationals over time. So there's quite a number of Chinese businesses now that dominate whole niches globally. We've recently added a business that manufactures medical devices in China. The China market slowed down for the reasons that the bubble there bursting, the property bubble bursting, local governments who fund hospitals being cash-strapped meant that demand for medical devices in China softened. But this business is 50% exposed to everywhere else, and it's growing quite rapidly overseas. And it's not relying on access to the US market. It's selling medical equipment to Indonesian hospitals, to Brazilian hospitals, and it's doing exactly what successful multinationals should do. It's investing in capacity in places like Mexico and what have you to diversify its global footprint. So there are a number of emerging multinationals coming out of China who, if they were overly exposed to the US, I guess the tariffs could be a headache, but many of them are really more trading with the rest of the world. At least those are the ones that we're interested in.
Very good answer. Well, some commentators out there are concerned about China's relationship with Taiwan. What has China got to benefit from invading Taiwan?
I mean, there doesn't really seem to be any benefit for anyone for this to descend into a full-blown conflict. It's a very hard thing to price as an investor. It's one of those sort of binary outcomes. We were able to avoid the fallout of Russia-Ukraine because we couldn't find Russian or Ukrainian businesses where we felt the governance models were strong enough to protect us. So that, as a very governance-focused investor, avoiding the fallout from that conflict wasn't particularly difficult. China, Taiwan is different because some of the Chinese businesses we look at are global leaders in their field. Taiwan is full of global leaders. We don't have a lot of exposure to domestic Taiwan. We are more invested in leading businesses that have built strong niches in particular technologies. And there aren't so many of those in other emerging markets. So businesses with very strong intellectual property available to us in Taiwan. So it's very difficult for us to say we'll avoid Taiwan or we'll avoid China, because actually there's some really good quality businesses that we think our clients will benefit from being exposed to. And we'll just have to monitor the developments and cross-strait relations. You would like to think that there'll be some form of accommodation before a full-blown conflict, but it's just one we have to. It's one of those risks that's out there, and you have to live with it.
And what are there any restrictions for foreign investors when they're looking to invest in emerging markets? Are there any countries that create restrictions?
Oh yes, less than there were over the years. There have been many markets that have had things like foreign investor limits or a foreign board that investors might have to pay a premium for their shares and what have you. A lot of that is going away. The market with the most significant restrictions, the most important market with the most significant restrictions is China. Whole sectors of the Chinese economy are technically off limits for foreign investors. Internet, media and education are technically out of bounds for foreign investors, which sort of begs the question as to how on earth some Chinese internet companies can be the biggest index constituents. And this comes to questions around alignment as well for us, in the sense that the very large Chinese internet businesses, the Alibabas, the Tencents, Meituans, they've accessed foreign capital through legal structures called VIEs, which are variable interest entities. It's a legal mechanism that was actually designed originally by Enron to hold assets off balance sheet and not consolidate them. And the lawyers have helped these companies divide these structures in order to access foreign capital. And the index providers have been happy to overlook the obvious weakness in the structure, and that you don't actually own the underlying company. But we've never been prepared to overlook that. We've benefited over the long run by not compromising on governance structures where alignment isn't sufficiently strong.
Goodness, I never knew that. So that's going to lead me on to my next question, which is, how do you define risk? What is risk to you?
Well, it follows on from that answer. For us, risk is losing money, permanent loss of capital. And in my experience, governance compromises in emerging markets are the quickest way to experience a permanent loss of capital. And therefore, from our perspective, it's just not worth making those compromises.
And we've spoken about AI, talked about tech to some degree. I read the other day that I think the population of India is nearly 1.5 billion people. And that is the same size as the population of North and South America and Europe combined. What is it that really attracts you about India as a place to invest?
So I mean, obviously the headline numbers in India are staggering, and for that reason, investors have a bit of a habit of extrapolating very strong growth for a very long time and paying very high multiples for Indian companies. So that can be a bit of a challenge.
Don't like doing.
We try not to do, and that can be a bit of a challenge. But there's no doubt the runway for growth of, many products and services within the context of a growing middle class is very robust for a long time to come. It's trying to find ways to access that at reasonable valuations has been challenging, although the mid-cap part of the market has been experiencing some sort of a correction. We have a large position, as I mentioned, in an Indian mortgage bank, which has a very, very long runway to grow. We have a large position in a leading healthcare business there that manufactures medicines. And of course, a feature of a growing middle class is better access to healthcare, and that's driven a very nice long-term domestic growth trend for this business that we own there. So looking for, oblique ways to get exposure to this that doesn't involve paying the very, very high multiples that some of the names have is sort of our challenge. But the opportunity is real. There are some sustainability risks that I think it's clear that India has to manage things like water scarcity risks. It's certainly at the forefront of those types of things, and thinking about that as an investment risk in the types of businesses that you own is important too.
And can emerging markets perform even during periods of high inflation, especially commodity price inflation?
Again, it cuts both ways. I mean, Latin America loves high commodity prices.
Of course.
And India and China obviously benefit from low, commodity input prices. So again, it's a very diverse asset class. I mean, African markets performed very, very well about 10 years ago when commodity prices were high, and they've had an awful decade since. So there's natural diversification across the wide range of countries that we look at.
Well, Glen, now let's move onto your business, Scarivore Asset Management. Firstly, where did the name come from?
So Skerryvore is the name of the tallest lighthouse off the west coast of Scotland. It's about 150 years old. It was designed by the Stevenson family based out of Edinburgh, and it stood the test of time. It marks a very significant rocky reef off Tiree. I do a little bit of sailing myself, and I know it's very treacherous out there. And prior to this lighthouse being constructed, it was a dangerous place to navigate. And of course, a lighthouse has enabled people to safely navigate this very rewarding but sometimes dangerous place. And we quite like that. It's sort of an analogy for an investment philosophy that, if you believe that emerging markets can be sometimes difficult to navigate, the idea of a sort of guiding light in the form of a lighthouse, we sort of felt summed up our approach.
I love the name. And you founded the business in 2019. What does it look like today?
Yeah, so I mean, we've evolved a lot from when we first started. We started as 8 founders. We're now 17 people. We're based in Edinburgh. And we have pooled vehicles available in Australia, Dublin UCITS vehicle, and some funds in the US as well. We've got a very diverse client base, a mix of institution and sort of wholesale type clients, a growing number of endowments and foundations coming into the funds as well. So, quite diversified, but emerging markets only investment boutique.
And how long have you managed this strategy yourself?
So I joined a firm called First State back in 2001, and there was a gentleman there called Angus Tulloch, who's retired now, but he's been running essentially this philosophy since 1988. I joined him in 2001, and I worked together with him until the end of 2014. I formally took over lead management around about 2007, I think. So yeah, quite a few years of implementing it.
And First State was, it's a very well-known company. And Angus Tulloch is one of the legends of our industry. We're so lucky to have worked for Angus. And I'm going to ask you a bit about him in a second. But before I do so, are you allowed to tell me about what your long-term track record is as a fund manager?
Yeah, I am. It's differentiated in the sense that we've delivered better returns than the benchmark and peer group over the long run, but at much lower levels of volatility than the benchmark as well. So it's a different type of track record. I think if you talk in terms of upside, downside capture, which people like to look at, we don't get all the upside because the conservative approach to governance and also valuation mean that we're often selling out of hot parts of the market maybe a little bit before other people. But that's protected us when markets have had tricky periods. So there's been very, very few down markets where the funds haven't done very well. So it's a different type of track record, a different type of approach, and it appeals to longer term investors who aren't so focused on the 1 year performance number.
I really like that because one of the best attributes of active fund management, if you lose less in the downturns, is that you keep the investor in the strategy and they don't bounce themselves out.
It leads to a better franchise. I mean, certainly that was our experience at First State. Coming through the global financial crisis, keeping people invested was important because there were super returns to be earned following it. I totally agree. I think it's for any kind of long term. Our approach is rooted in trying to generate absolute returns over the long term.
Oh, that's a very key word. So you're not a relative return investor. Over the long term, you're an absolute return investor.
Yeah, I think that's why on earth would one take the additional? Why would people put their assets into emerging market equity if it wasn't to generate an acceptable absolute return?
Yeah, you can't spend relative returns at Tesco's, can you?
No.
So going back to Angus Tulloch, because I learned an awful lot from Angus, just being a client of his for many years. Are there any golden rules which he taught you, which are sort of imprinted on your brain, which you still adhere to today?
Yeah, I mean, Angus, as you say, a phenomenal track record over his career. And I learned an awful lot from him. What I would say, the golden rule that we very firmly continue to stick to today is about not compromising on governance. Angus had a very, very strong ability to identify people with integrity. Meeting hundreds and hundreds of management teams around Asia and emerging markets, he was very good at filtering out, groups where you really felt that they viewed you, the minority shareholder, as an equal owner of the business alongside them, and your rights would be, taken into account when in any kind of capital allocation decisions that they're making. And he was extremely good at that and good at avoiding many of the banana skins, which are, as I've said, normally governance related in emerging markets. So and we very much stick to that rule today.
Fantastic. And focusing the limelight on you just for a second, what are the skills which you individually have, you yourself, that you think bring the most to the team?
We run and I'd say this comes from Angus as well, I think, is we run a very non-hierarchical team. So really, there's no owner of the truth on any holding that we have. And one has to be quite thick-skinned, I think, we've got very experienced investors on our team. I think the average investment experience is 22 years or thereabouts. So there's no point in having such an experienced team if you're not prepared to be fully challenged by them. Yeah. So having a bit of a thick skin is an important part of it. And then I think the other thing that I've brought was over my career is you know, I enjoy investing. I get excited when I find an opportunity that appears to be of good quality and reasonably priced. I actually get really excited about it, and enjoying going around looking for those sorts of opportunities. Hopefully, drives a sort of a flywheel of decent ideas coming onto a watch list and keeps a portfolio sort of fresh.
So you've touched on the team's experience, which is pretty incredible. But what makes your team so special in your eyes?
There's a few. Obviously, experience is a huge part of it. But I think there's a few things. We don't pay anyone based on 1 year relative returns. Everyone on the team is invested in the strategy personally. So essentially run their own money alongside client money. And we run the funds as with this absolute return goal, which is exactly how we would wish our own assets were run. So I think that drives certain behaviours, such as the willingness to say, I think maybe TSMC is getting quite fully priced, and it might be the largest stock in the index, but if you don't see material upside to owning it, we won't hold it. So we're able to be very, very different to the benchmark. The boutique ownership structure is quite important as well. So the investors also own the business, and the business was established to invest in this way. So the ownership structure and the investment philosophy are completely matched together. You don't get, as you do in bigger firms, a new CEO or a new CIO appearing and bringing their changes and what have you. There's a consistency of approach that comes with having a very aligned ownership model. The team is an interesting group of people in the sense that many of us have had jobs before we became investors. I worked in the oil industry. I was a geophysicist for a few years before I started working with Angus. And many of us have had careers before investing, which I think leads to a broader perspective.
And does that help avoid group thinking?
I think it does. Yeah, it certainly. I mean, we have one investor who had worked at one of the very large consultancies before, and not only does he bring a certain amount of knowledge about IT and the IT consultancies, but also a very different perspective to someone who studied engineering and geophysics and things like that. So I think it does bring broader perspectives.
And if there's one thing you as a team are striving to get better at, because I can tell you're all very competitive to do a great job, what is it that you at the moment are striving to get better at?
So when we describe our philosophy, we say that there's 3 to 4 extremely important elements to a business being considered good enough to own on behalf of clients. The first is the history of governance and alignment. We've talked a lot about that. The second is a franchise that has pricing power in order to keep up and beat inflation. And the last is a very strong balance sheet. So it doesn't have to be net cash, but many of the companies that we invest in fact, the majority of companies that we own have no debt. And then finally, it has to be behaving sustainably. So that's not to confuse it with sustainability targets, but to say if a business is knowingly polluting the drinking water of people around its factory, it's telling you, it goes all the way back to the beginning. That's telling you something about the integrity of the people running the business, and why do you think they would ultimately treat you any better as a minority shareholder if they're prepared to treat other stakeholders poorly. So those are the 4 things that we're looking for. We've done a good job over the long run of not making governance mistakes. So that sort of golden rule we've adhered to very well. We've never had a company go bankrupt on us, so that the balance sheet side has held up okay.
Yeah.
We've had, all of our consumer companies got hit with COVID, but none of them got into financial difficulties because of the balance sheet element. Where we've made the most mistakes over our careers is buying franchises that haven't been strong enough. So, i.e., they may have had pricing power, but the pricing power is sort of deteriorating over time. It might be because of new competition. It might be because of a lack of investment in innovation. But and we've been historically, I feel we've been a little bit too slow to to get out of franchises that are withering on the vine a bit. And that's certainly an area that we're striving to be better, being more ruthless, if you like. If companies are failing to meet what are our hopefully conservative assumptions over 1 year, 1.5 years, not sitting there and hoping for the best, but actually saying, look, let's get this out of the portfolio and own a business that's actually demonstrating strong pricing power. I think that's probably the area where we've made most mistakes.
What a wonderfully honest answer. And you've touched on it already, but could you, in a nutshell, give me your investment philosophy?
Yeah, I mean, this is it. It's these. We protect our watch list from poor quality businesses by studying the history of governance and alignment, studying the history of returns, margins, pricing power, reinvestment in innovation or intellectual property development, in order to really, we want honest people running strong businesses, and then a deep study, deep understanding of balance sheets as well. So that's essentially how we build our watch list. We've got about over 300 businesses on the watch list that we've identified over the 25 years or so that we've been looking at emerging markets. And obviously there's turnover in the watch list, things change and companies leave and new companies come in. Within the watch list, we have our highest priority part of the watch list, which is probably about 20 of the 300 or so companies, where we feel valuations are becoming quite interesting. And they're close to competing for capital as a holding in the actual strategy. And then we have the portfolio itself, which is where that subset of around about 45 holdings today trade at a valuation that we can credibly prove to ourselves that 10 to 12% per annum absolute return is realistic over a 5-year period.
And what percentage of stocks in your portfolio are actually listed on developed market exchanges?
It varies. 10 to 15% has been the historical sort of average. And there's kind of two different types of companies that trade on developed world exchanges, and we look at both. The first is an emerging market business that's chosen to raise capital in the developed world. So I think a good example of that would be the Coca-Cola bottler for West Africa and Eastern Europe. It's a Greek family-controlled business. They were very nervous about Greece and falling out of the euro back in 2008, so they moved the primary listing to London. So if you want to buy soft drink consumption in West Africa, you can buy a London-based share and get some very high-quality exposure. So that's an EM business that's access capital in the developed world.
And is there an advantage of having some of your portfolio listed on developed market exchanges in terms of liquidity?
So long as the quality of the business is sufficiently good, then yes, it gives you a broader universe of stocks to pick from.
And how important do you think it is to trust company management?
I mean, it's at the heart of everything that we do. I mean, there's two elements of trust. There's trust that they will treat stakeholders fairly, and then there's trust that they can actually execute on the strategy. So there's two elements to that, and we're looking for both in large quantities. So we're looking at we like looking at long track records, because assessing trust, you can't go onto Bloomberg. There's no price to trust ratio. There's no price to integrity ratio. So all you can do is study history and say, we were looking at a Chinese company just a couple of weeks ago, and we noticed that in 2012 there'd been a rights issue. And when we investigated the rights issue, it turned out that the chairman, it was a discounted rights issue to his own family. So that's just a straight, disadvantage your minorities. Yeah. And apart from that, we couldn't find anything wrong with the company. It looks like a great company. But because he's done that, it's
a no.
It's a no. It can't progress through our process.
So what percentage of the companies in your portfolio have significant founder holdings in them?
A large number. So there's different types of governance models that we look for. And a founder, so the actual founder still being involved and invested in the same equity, is one that we quite like, so long as they're a proven executor. Families of founders where they act as a sort of steward of capital. We quite like those. We've got quite a number of those types of companies where at the board and shareholder level, you'll have a family, but the business is run entirely professionally. And the family acts to protect the interests of all the shareholders. So the management may want to leverage up the balance sheet, but the family will say, well, actually, we don't want to leverage up the balance sheet.
Not on my watch.
Not on my watch, exactly. So we like those types of governance structures. But we also own businesses where, they are ownerless. I mean, some markets have more ownerless corporations. The South African market, for example, there's a lot of companies there with very strong boards and governance models, but there isn't necessarily an identifiable owner. But so it's really about assessing the strength of a governance model and long track records. The longer the track record, the better, because then you can take it.
Is it funny though? It's so true, isn't it? The further you go back in history, the easier it is to look forward.
Yes, exactly. Yeah.
In terms of trying to work out what might happen in the future.
Yeah.
So what's the longest you've held a company for?
So we had a look at this yesterday for you.
Did you?
We think it's a South African pharmacy chain called Clicks. It used to be called Nuclix, and now it's called Clicks. And anyone who's been to South Africa will see it essentially looks like Boots of South Africa. The leading pharmacy operator down there. And I met this company all the way back when I first started working in the industry in the very early 2000s. And we went to their headquarter building, and in the lobby there was a sign, and it was before people really had access to stock market data on telephones or anything like that. And it said, today's share price is 14 Rand. Tomorrow's share price is up to you. And we just say, it gives a window into the culture of the company that, that people were, it was about value creation. And obviously we asked the management team about the origin of the sign. And yes, all of our...
So how long have you owned the company for?
Since all the way back then, so over certainly 25 years.
Fantastic. And what is the oldest company that you own in your strategy?
So we had another look at this. We own it's a good example of a developed world listed company that we've identified. In Lisbon, Portugal, we own a company called Geronimo Martins, and it's 350 years old. I think it's just over 350 years old. And it started with a single store in Lisbon, but it's now the leading discount retailer in Poland. It's building a chain of stores in Colombia, and obviously it has its legacy Portuguese business as well. It's got a controlling family, the Dos Santos family, who've owned it for generations. It's got no debt, and it's got an excellent track record of managing inflation in the markets where it operates. So it sort of ticks all of our
key
kind of quality metrics, and 350 years to look at.
And what is your average stock holding period? Because you did mention earlier on when you were going into a stock what you're looking for it to do. In reality, things change a little bit.
Yeah. So the turnover of the fund would suggest we hold stocks for 5 to 7 years, 20% turnover thereabouts. But turnover goes up and down. And when COVID hit, we added 6 new companies to the portfolio. This is the nice thing about having a watch list of quality companies. That when they drop, you can act quickly to get them into the portfolio. So the turnover can be in falling markets, our turnover goes up because names become attractive.
They pop up and wink at you.
Yes.
And what is the scope of number of holdings you're prepared to hold in the portfolio? At the moment, you said you hold 40...
Yeah, in the mid to low 40s.
Mid to low 40s.
Yeah. Mm-hmm.
And that number is the sweet spot for the strategy, is it?
I think you want a certain amount of concentration. You want a strategy such as our one should have the conviction to back its strongest ideas. So we're quite comfortable having the top 10 holdings being anything up to 50% of the portfolio, and with a tail of interesting names, then from there on down. And we have written within the rules of the strategy we can be up to 80 holdings, but I think that would be unlikely that we would. I think this sort of 40 to 50 number is probably about right.
Is about the right one for you. And if I was listening to this conversation we're having today, I'd also want to know whether or not I'm going into a smaller company fund or not fund portfolio, or I'm going into a large cap portfolio through your strategy. Where do you sit in terms of the range of market capitalizations within the portfolio?
Yeah, so the median market cap in our portfolio is about $18 billion US, which I would say puts us as mid-cap investors.
Yes.
The smallest company we hold is only about $800 million market cap. And the largest company that we've been reducing but continue to own a bit of is TSMC with over $1 trillion of market cap. So and that throws the average up to more like $80 billion. But I think the median is a more illustrative number at 18. So it's the mid cap, and this is where we find these, founder family-led firms with or businesses that still have long runways to keep growing. So we're certainly not a mega cap fund by any means.
So cheeky question here, which I asked you to look up the answer for me before our conversation today. How many stocks in your portfolio do you think today have got the potential to double over the next 3 years?
So looking across we have 5-year price targets for all of our holdings, and looking across the portfolio today, based on our assessment of what these companies might be worth in 5 years, that 10 to 12% hurdle that we set ourselves looks achievable. Maybe not in the most expensive technology stock that we've discussed, but across the whole portfolio. And we reduce names, or we think that it's not going to be possible. So yeah, I mean, mathematically, doubling your money on a sort of five-year view, maybe rather than 3-year view, should be realistic.
But that's a wonderful return for somebody who wants to keep their head above water versus inflation.
I think so, and I mean I've certainly been buying the fund personally because I think the same thing. We are in a world where, I mean, there's no doubt the gold price is telling you something about what investors are thinking about governments' fiscal positions and things like that. So a basket of very well governed, strong franchises that should compound even in an economic sort of downturn with balance sheets that can weather recessions feels like a good place to be.
And how does a new investment get into the portfolio?
So we're constantly meeting companies, hundreds of companies a year.
Teams, how many people in the team?
So we're 17 people across the firm, and 7 of us full-time.
7 of you full-time, yeah. Of course, you mentioned
full-time stock picking, yeah. And so we meet up 200 plus companies every year. Everyone's a generalist, so everyone has the freedom to, say, I've met XYZ Chinese industrial. I'd like to do some more work on it. If the team broadly agrees that it's a sensible area for us to spend effort, then a team member will go away and produce a very in-depth due diligence document which studies history. It's all about the history of who the people are, how capital's been allocated, how stakeholders have been treated, and then this document is discussed at our regular investment team meeting. We do a written Q&A. In the past, we always had a sort of a quick-fire question and answer in the meeting, but we found that it was too easy to duck the difficult questions in those situations. So we now have written Q&A where the analyst
nowhere to hide,
and there's nowhere to hide. You actually have to answer the question, and everyone agrees. Actually, answering the written Q&A is often harder than writing the actual original report. So at that point, a decision would be made that a company is good enough quality, and then we would start to discuss valuation. So we very much put valuation at the end of the process. So, and I think that helps us not get. We'll never start looking at something just because it's cheap, because I think we need to look at it because it's very good, and then is it cheap enough? It would be the question. Might you earn 10 to 12% per annum?
When will you sell a stock?
So there's well, generally speaking, there's two types of sells, and one is where the thesis is played out, and you've achieved your 10 to 12%, perhaps a little bit ahead of time. Oftentimes, the market, can give you the returns a bit sooner than your nice linear model assumes. So, selling on valuation grounds and moving it back to the watch list and keeping an eye on it and hoping to get another opportunity to own it in the future. And then there's the less good sell where the investment thesis hasn't played out. And there's different ways that can happen. I mean, you could have an emerging governance concern. So I mentioned, in Egypt, we had the government step in and remove the chairman of a bank that we held and had long admired. And that was an event that we couldn't justify continuing to own the business. So it's a change in the governance model led us to exit the holding and actually remove it from the watch list because if the government's choosing the chairman, it's not what we invested in.
It's not good, is it?
And then there's this emerging franchise concern, where you're getting quarter after quarter of deteriorating results, and your belief that the company had sustainable pricing power is ultimately being eroded, and trying to be a little bit quicker to recognize those and get them out of the portfolio is another sell decision.
And so, as a team, you're set up to be better buyers or sellers of stocks?
I think history would suggest we've been better buyers, and I think this is linked to the philosophy. If you buy a little bit too early or you buy ahead of an event, so long as you've maintained conviction in the integrity, honesty, governance structure, the fact that the business is suddenly 30% cheaper only makes you want to buy more of it. So the conviction to add it when things fall is higher because of the level of work we've done building confidence in the people behind the businesses. So I think, we've proven to be quite good at buying in downturns historically. Selling is a different discipline. There's different types of sell mistakes. One, selling too early, hanging on too long, but we try to keep it rooted in valuation. And are you going to earn an acceptable absolute return from here?
And then do you trade around a position to take advantage of short-term market volatility, or do you just sit on your hands and let the company do its own magic?
We do. As companies approach price targets, obviously your perception of what you might earn from holding it, is obviously it's a shrinking return. So we might have a company that's performed a little bit better than we might have expected, and you're only seeing an 8% likely return for the coming 5 years. That to us is probably at the margin a reduce. Mm-hmm. And similarly, we have examples where nothing's really changed other than the price of the stock, and you're looking at a sort of 15, 16% expected return, and we're going to add to those types of positions as well. So it's linked to our view of what the absolute return potential is.
I love this question. I thought when I was thinking of what to ask you, which sectors are just too difficult, too dangerous, or just too goddamn boring to invest in?
There are biases in the fund. Anyone who looks at the fact sheet will see some of these biases. It's we're biased towards really well-run, inflation-protected consumer-type businesses, and businesses that have a long history of generating strong IP, because that gives us conviction in what's hopefully going to be sustainable pricing power. And there are sectors that simply don't lend themselves to pricing power, having pricing power. So regulated utilities. We don't own any sort of regulated electricity generation companies because ultimately they're not in control of their own destiny. Our Coca-Cola bottlers have endless revenue management levers they can pull with shrinking pack sizes, fiddling with the recipe, all the things that they can do to manage their margins and manage inflation. When a government is setting the price of the electricity or the water or whatever utility it is, that's just not a form of pricing power that we're confident in. Similarly, we have no exposure to oil and gas or mining businesses today, directly to mining businesses today. And that is a bit of a feature of EM, that the best natural resource assets around EM exist in the worst governance structures. So Brazilian oil fields are very valuable, but Petrobras is very hard to say that it's run for the benefit of its minority shareholders. Yes. Gazprom's gas fields are valuable, but clearly worth nothing to foreign investors. So it's hard to find top-tier assets inside governance structures in those industries.
And which sectors give your investors the best risk reward in your universe?
Well, I mean, it's a myriad. I mean, if everything across very strong brand owning consumer companies, very efficiently run retailers. We own some e-commerce businesses. We own a leading e-commerce business in Latin America, where very unusually for that industry, it's one share, one vote. So we actually sit alongside the founder in this business and they don't have super voting rights or anything like this, which is a feature of those industries. So we can find e-commerce type businesses where there isn't a governance compromise to be made either, away from China. But so yeah, sectors where you believe that that both the ability to grow and have sustainable pricing power, so not have growing with deteriorating margins. And sectors.
And then you mentioned it earlier on, but what are your risk controls in terms of stock, sector, and country level?
Yeah, so we have some rules: no more than 50% in a single country, and no more than 50% in a single sector. And we're not allowed to have more than 10% in cash, although in reality we run cash fairly close to zero, because we believe our investors they want us to allocate their money to leading emerging market firms, not sit on their cash. So yes, those rules are designed to create some diversification in the portfolio, but also give us a lot of freedom to express where we think the best ideas are.
And how does the concept of sustainability feature in your portfolios?
Yeah, I mean, simply put, if a business is not acting sustainably, it won't be able to carry on. So we think of sustainability and investment as they're just two sides of the same coin. So, a business that generates it, that if its pricing power, the source of its pricing power, is not treating its waste, at some point that's going to become a financial problem for you. So, or if it's a modern slavery type issue, it's going to become a boycott issue or a financial penalty issue. So, yeah, simply businesses that are not acting sustainably are likely to be poor investments.
And what are the three biggest country exposures in the portfolio at the moment?
Yeah, so currently we would have India as the largest country exposure, followed by Taiwan, and then Mexico. But I guess what's somewhat interesting is some of our Indian holdings are very global in nature. Our Taiwanese businesses are extremely global companies. And the names we hold in Mexico actually have pan-Latin American franchises in many cases. So the headline country weights don't really give you a true picture of how diversified the sort of sources of cash flow that the portfolio enjoys.
Of course. And let's just touch on the active fund management versus passive fund management and ETF index trackers. What do you think are the pitfalls or dangers that are potentially involved for investors getting into index trackers in emerging markets?
Yeah, so this comment I'll caveat by saying this is specifically about emerging markets. So if you sort of compare an emerging market index to a US or developed world index, the large companies making up a developed world index are generally speaking businesses that have been very successful and have built their market cap by growing a huge franchise. if you look at the emerging markets index, it's really quite different. There are some of those that have grown under very strong leadership and built huge franchises, but there are many listed bits of government. Say Petrobras is the Ministry of Energy in Brazil. The Chinese banks are an extension of the Ministry of Finance in China, and will be directed by the ministry to achieve whatever aims it wishes. There's a very large state-owned banking sector in India, which I would not claim was run for the benefit of all shareholders. It's a politically driven sort of sector, but because these are big, they're also represented in the index. So to buy an EM index fund exposes you to some of these very good names, but also lots of these names where I think if you looked at it standalone, you'd probably rather not be exposed to it.
Absolutely fascinating, which of course brings me to my next question, which you may be able to give me some sort of indication on, is what is the active share, i.e. the percentage of your portfolio that is not replicated by the index?
Yeah, we've always run very high active share portfolios, and we're in and around 95, I believe, at the moment.
And that's a proper active fund, isn't it?
Yeah, it's very different to the benchmark.
Very, very different indeed. In this AI-driven world that we are living and breathing in today, do you think active fund management has got a bright future?
I mean, I hope so. I think that AI, we were using it ourselves as a sort of a productivity improvement tool. We use it across the firm. And clearly it should bring efficiencies to businesses in our portfolio that potentially help them with returns. I've mentioned Coca-Cola bottles a few times, but they're utilizing all sorts of AI solutions to help with their revenue management system and what have you, to make sure their distribution can be even more efficient. So I think there's no doubt there's some useful tools emerging. I'm not sure that AI will ever be particularly good at assessing integrity in the way that we go about looking for governance models, which is a very subjective activity. What is acceptable? Ultimately, judging integrity is about operating in the grey.
Absolutely.
And I'm not sure that AI is there just yet.
I think that's a brilliant answer. How will you judge yourself in terms of how successful you have been when one day you decide to retire?
Yeah, I think to look back over one's sort of whole track record, and it would be very pleasing to see that we'd done or even beaten the hurdle that we set out for ourselves. After 10 quite poor years for EM, I'm a little bit off the pace at the moment. My annual return is just sub 10 at the moment.
10%.
Yeah, since I began running the fund. So it's and we have our long-term track record. So yeah, to achieve the hurdle rate that we've set ourselves over the rest of my career would be, I think you could look back on and say, you've done a reasonably good job for clients.
Well, Glenn, I've thoroughly enjoyed talking to you this morning. I've learned so much, and I can see that actually investing in emerging markets is so to do it successfully is so dependent upon making sure that you are investing in management that you can trust and great businesses which are sustainable. Thank you very much.
Thank you.